A short-term business loan can either save your business or silently destroy it. Most business owners don't fail because their business idea is bad. They fail because they take the wrong loan at the wrong time for the wrong reason. In this video, the real concept of short-term business loan explained with practical examples. A short-term business loan is not extra money. That's the first dangerous misunderstanding. It is borrowed time, and time always has a price. Short-term loans are designed to solve temporary cash gaps, not permanent business problems. If your business model is broken, this loan will only hide the problem until it explodes. In simple terms, a short-term business loan is money you borrow for a short period, usually between 3 months to 18 months. The repayment happens fast, weekly or daily in many cases. This is where most business owners panic later. They look at the loan amount and ignore the repayment speed. Let's take a practical example. Imagine a small manufacturing business that receives a large order worth $200,000. The client will pay after 60 days, but the business needs money now to buy raw material and pay workers. This is a classic good use case for a short-term loan. The loan bridges timing, not profitability. The business already has profit locked in the order. Now, the dangerous example. A retail store is struggling with low sales. Inventory is not moving. Expenses are high. The owner takes a short-term loan to boost operations. Nothing changes. Sales don't magically increase. Now the business has the same problems, plus daily loan deductions. This is how businesses suffocate. Short-term loans come in different forms: bank working capital loans, online merchant cash advances, invoice financing, line of credit drawdowns, and trade finance loans. They look different on paper, but the cash pressure effect is similar: fast repayment, constant deduction, zero breathing room if misused. Another thing most owners don't realize is that lenders don't care if your business survives. They care if cash keeps flowing back to them. That's why approvals feel easy and fast. Speed is not kindness. Speed is risk being transferred to you. Here's a truth that hurts. If a lender is not asking detailed questions about how the loan will be used, they already know the math works in their favor. Short-term business loans are designed to solve temporary cash problems, not long-term business weaknesses. When used correctly, they help businesses bridge timing gaps between expenses and incoming revenue. The key is clarity before borrowing. You must know exactly how much cash will come in, when it will arrive, and how the repayment will fit into that flow. A short-term loan should support operations, not pressure them. If the repayment schedule matches your real cash cycle, the loan stays manageable. If it does not, even a small amount can quietly strain daily operations. Smart owners borrow with numbers, not hope. Most business owners look at only one number before taking a short-term loan: the loan amount. Rich business owners look at a completely different number: cash leaving the business every single week. This difference alone decides survival. Let's walk through a real, practical example. You take a short-term business loan of $50,000 for 12 months. The lender says the total repayment will be $60,000. Many owners feel relieved. Only $10,000 extra, they think. This is where the trap starts. Now break it down. $60,000 divided by 12 months means $5,000 per month. Sounds manageable, right? But many short-term loans don't collect monthly. They collect weekly or daily. $5,000 per month becomes roughly $1,250 every week. That money leaves your account whether your sales came in or not. There is no pause button, no adjustment for slow weeks, no sympathy for delays. Now ask yourself a brutal question most owners avoid. Does my business generate extra cash every week consistently after expenses? If the answer is no, the loan is already dangerous. Here's what really happens in real life. One slow week comes. Payroll still needs to be paid. The loan deduction hits the account. Your balance drops, stress rises, decisions become emotional. You delay vendors, you skip marketing, you start borrowing again to survive repayments. This is how one loan becomes 2, then 3. Another hidden danger is effective interest cost. Short-term loans often advertise simple rates, not real annual cost. A loan that looks like 20% can actually cost 40 to 60% annually when fees, processing charges, and early deductions are included. Lenders know this. They structure repayments early so they recover most of their money fast. If your business fails later, they're already protected. Here's something rich business owners always calculate before borrowing. What happens if revenue drops by 20% for 2 months? If the business collapses under that scenario, the loan is rejected instantly. They don't hope. They stress test. They also match loan tenure with cash conversion cycles. If your business takes 60 days to turn inventory into cash, a loan with daily repayment is a mismatch. That mismatch alone can crush a profitable business. And here's the scariest truth. Short-term loans don't fail suddenly. They fail quietly. The business keeps running, but the owner feels constantly tired, anxious, and stuck. Growth stops. Creativity dies. Everything goes into survival mode. Rich business owners follow strict rules with short-term business loans. They don't negotiate with emotions. They don't borrow because they are scared. They borrow only when the math protects them. A short-term loan must create cash before its first major repayment cycle hurts. If the loan does not directly increase cash inflow within weeks, it is rejected. They never use short-term loans for long-term fixes like branding, expansion dreams, or lifestyle support. That's how businesses bleed silently. Here's a practical example of safe usage. A service business gets a contract that requires hiring temporary staff and buying software licenses up front. The contract pays monthly and is already signed. A short-term loan is used to cover the upfront cost. The new revenue pays the loan. This is not borrowing for hope. This is borrowing against certainty. A short-term loan should reduce stress, not increase it. If taking the loan makes you anxious at night, your instincts are warning you. The smartest business owners don't win because they borrow more. They win because they borrow precisely. They use short-term loans like scalpels, not hammers. One clean cut, one clear purpose. Then they exit fast. If you remember only one thing from this video, remember this. Short-term loans don't fix businesses. They amplify whatever already exists. If you found this video helpful, then like, share, and subscribe this channel to get future videos. Thank you for watching this video.